Hi, everyone. Thanks for tuning in. My name is Dana Moody, and I'm a member of the Index Sales Group here at FTSE Russell. And just to set the stage for today's discussion, we'll be touching on recent market trends we're seeing with the increased adoption of international equity ETFs by investors, but also we'll be touching on best practices for portfolio construction. We have a great panel today. I'm joined by Catherine Yoshimoto. She's a director of equity product here at FTSE Russell. We also have Andrey Kotlyarenko. He's a senior equity product specialist at Vanguard. And lastly, we have Mark Barnes. He's the head of Investment and Research Americas at FTSE Russell. And just to jump into today's discussion, as I alluded to, we'll be touching on international equity ETFs. Obviously, a lot going on in the markets. So with the first question, over the last several years, we've been seeing a lot of market participants reassess portfolio construction in terms of that traditional 60-40 split between bonds and equities, reassessing the potential over-allocation to US equities. However, through this reassessment, trends and ETF flows seem to stay pretty consistent with historical norms. So I would love to get the panel's thoughts on that. So starting with you, Mark, what do you believe is leading to some of these trends?
I think we've seen some really interesting trends in the markets and changes in the markets related to this topic of ETF adoption. So one thing is if you just look at equity performance, that really jumps out. So the performance of many regions outside the US in 2025 relative to 2024 has been just sort of a sea change. You see that a lot of regions have outperformed the US in 2025, whereas they were underperforming in 2024 and actually in previous periods. You don't have to go back that far. And some people are asking, do we even need to invest outside the United States? And so just that flip in performance, I think, is a really interesting change. Now, some of this is due to, if you're calculating your returns in US dollars, because of the weakness of the US dollar that we've seen year to date. The euro, for example, has appreciated something like 13% against US dollar, British pound 5 or 6%, and so on. And this is not only related to equities, but this impacts any asset that non-US asset that US investors hold, and that provides just a tailwind for investing outside the US. We sometimes see long swings in the dollar, so this may actually persist. And then if you look at the US specifically, as you alluded to, we do see some risks in the US market. Valuation, the US is trading at something like 27 times earnings, trailing earnings, something like 22 times forward earnings, whereas many of the other regions are around 15 or 16, so much cheaper. And then just the concentration. I mean, the US in the broad FTSE All-World Index, the US is up to something like 63%. You go back 15 years and it's down around 40%. So I think, and this is not to say that investors should be chasing returns. It's more that investors need to know what the opportunity sets, what the opportunities are outside of their portfolios, and then also what the risks are within their portfolios.
Thanks, Mark. So you highlighted performance, but also just an awareness by market participants. So to dig on the point about awareness in terms of clients, Andrey, what are you seeing from Vanguard's clients in this space?
Yeah, Mark brought up a lot of very valid and very interesting points, and that just to bring him to light a little bit more on the home bias, right? Even though the concentration in the US market have been growing just from the pure market cap exposure, we're still seeing an even more significant home bias on where the client's actually directing their assets, right? So with the FTSE Global All Cap, US representing about 63%, when we look at the actual flows, the split is closer to 80-20, with 80% of flows directed to the US market and just 20% directed to the international market. This is not surprising based on the performance that we've seen in the marketplace, and over the last 10 years, US meaningfully outperforming the international equities. And as a really aligned with that, consumers haven't really been rebalancing their portfolio to come closer in line with the market cap weights. And even furthermore, they've been concentrating their exposure to the US market, probably out of a fear not to miss out in this great rally that we've experienced over the last 10 years, right? But in the past year, since the beginning of 2025, we've seen a bit of a pivotal point, right? Where now international market is all of a sudden having some stronger numbers than US, right? And this kind of reminds, a good reminder that diversification benefits are still there. when we look at the globally diversified portfolio, the overall volatility of that strategy is significantly reduced against just a purely single region concentration like US market, right? In addition to that, the diversification is further highlighted as you gaining exposure through the global equities to diverse economic cycles, diverse industries, as well as diverse regulatory environments, right? All of those in concert contributing to further reduction in overall risk of the portfolio. Another factor to remember, while we're seeing the increased exposure to the US market, also within the US market, the recent market dynamics caused significant concentration to just a few select securities. Taking like total stock market, the top 10 names represent close to a third of the US market at this point, and majority of those securities are tech sector. And that's definitely been concern for some of our clients and been part of the many conversations that we're having. One thing that we want to caution as people considering to move away from this concentration, before you go to extremes of fully reallocating your portfolio and go into strategies like equal weighted approach that could significantly increase the turnover, drive the cost of trading, as well as increase the potential for capital gain distributions, maybe considering more balanced distribution across the global equities to really reduce some of that concentrated risk.
Thanks, Andrey. Thanks for providing that perspective from the end client, end investor, and best practices around that. Further to the client element, Catherine, for FTSE Russell clients, what are we seeing?
Yeah, for FTSE Russell clients, just like Andrey indicated, we're seeing a lot of, continuing to follow the global and develop the broad benchmarks. I think, to Andrey's point, there might be a fear of missing out, but also kind of a naive view in the sense that without further information to do otherwise, that investors perhaps would rather follow the broad portfolio in order to not miss out on the opportunities. Now, that being said, there are also pockets of interest, even developed or emerging markets. And despite some of the geopolitical concerns around, say China, for example, in recent months, investors are being thoughtful about those allocations. While some market participants may choose to exclude China completely from their emerging portfolio, there are others who are also trying to be more targeted in their approach. So some of our clients are excluding Chinese state-owned enterprises, so SOEs that are government-owned and have more influence from the Chinese government. So there are approaches like that. And in fact, though, China and Taiwan technology indices have been actually gaining a lot of popularity, perhaps because of its AI tie and also maybe diversification outside of the US Magnificent Seven companies that have become very, very large. In terms of risk reduction approaches, I think some of our clients are also gravitating toward dividend strategies. So the dividend yield or dividend growth stocks that provide a bit of cushion, maybe in downside protection in some volatile market environments. So those are the types of indices that we're seeing. And also in terms of the passive growth in general and just total asset growth over the past decade, since FTSE Russell came together in 2015, we have some asset data, split data going back to 2015. The passive allocation was already almost a quarter, but the total assets have doubled, and now the total assets benchmarked to a FTSE Russell index has grown to $20 trillion as of the end of 2024, and $5 trillion of that is in passive assets. So you see just the general asset growth over the past decade, as well as the stickiness of passive and influence that some of these trends in the markets have on investor behavior.
Definitely. Well, thank you for that perspective, Catherine. All right, with that, I want to thank our panel for joining and providing great insights into recent market trends in terms of increased adoption of international equity ETFs by investors, but also best practices for portfolio construction to gain exposure to some of these market themes. Thank you.